We'll go to chapter 3 in economics A level, business objectives. When we talk about business objectives, we're simply talking about what a firm is aiming to achieve over its operational period. That's what a business objective is. Your aim, what you want to achieve over a period of time. That is what a business objective is. So here I wrote, a business objective is a result of that a firm aims to achieve. It forms part of the planning process for firms and will influence the pricing policies and the planned output for the firm. As a firm, you have an objective. So whatever your objective is, it will be part of your planning in terms of pricing and in terms of output. Like a firm that is aiming at profit maximizing. To maximize profit, it means you have to sell at the highest possible price in the market, and you have to produce at the lowest possible output in the market. Do you get the point here? So that's why your objective will be based on your plans. So if your objective, like I said earlier, if your objective is to maximize profit, it means you have to sell at the highest possible price. And whatever you are producing has to be less, because when you produce more, it reduces the value. Do you get the point here? If supply exceeds demand, price is not going to be high. But if demand exceeds supply, then you can be able to sell at a higher price. That's why a profit maximizing firm will want to sell where marginal revenue equals to marginal cost. Do you get the point I'm making here?
Yes.
Great. So what are the main objectives of a firm? One, profit maximization, revenue maximization, sales volume maximization, and profit satisficing. So we're going to start with profit maximization. When we talk about profit maximization, we're simply talking about making the highest possible profit in that market. That is your objective. So in neoclassical economics. When we talk about neoclassical economics, we're talking about economic theory that focuses on interaction between demand and supply, individual utility, and equilibrium output. That is what neoclassical economics is about. They focus on the interaction between demand and supply. They focus on individual maximization, and they focus on equilibrium, level of output. That is what neoclassical economics is about. So here I wrote, the economics that focuses on the interaction of supply and demand, which we already know. Demand means the quantity of goods and services consumers are willing to buy at a given price and time. Then we talk about supply, which is the quantity of goods or services producers are willing to sell at a given price and time. So the interaction between them is what neoclassical economics focus on. Then, utility maximization. When we talk about utility, we're talking about the amount of satisfaction that can be derived from the consumption of any commodity. Neoclassical economics focuses on that too. As a result of that, so whatever is being produced, it's all about the market equilibrium, where demand equals to supply. So that is basically the interaction between demand and supply. We want equilibrium, and that is what the neoclassical economics focus on. Is it clear?
Mm-hmm.
So we are still on profit maximization. So here I wrote, okay. Here I said that all economic agents will want to maximize their satisfaction. Consumers, they attempt to maximize their satisfaction in whatever they purchase. For workers, they tend to maximize their rewards for the job they do. And for owners of the business, like shareholders, they want to maximize their gain because that is the reward for investment. So this is what maximization is all about. Consumer wants to maximize their satisfaction in whatever they consume. Workers, they want to maximize their satisfaction, their reward for the job they do. And for the owners of the business, like shareholders or investors, they want to also maximize their gain because that is the reward for the efforts, for the sacrifice they make. I think the point is clear.
Mm-hmm.
So for the neoclassical economics, they assume that firms aim to maximize short-run profits. This is achieved where marginal cost equals to marginal revenue in the short run. For neoclassical, I told you earlier, the aim is to maximize profits in the short run. So what do? They adjust price every now and then. They adjust price, they adjust output to suit the market condition. Do you get the point here? To maximize profit in the short run, according to neoclassical economists, it means we have to adjust price at any point in time. We have to adjust output at any point in time to suit the market condition. So if in the market, because it's about demand, the interaction between demand and supply. So if the demand in the market increases, we adjust price. If the supply in the market increases, we adjust output. So that would always put them that will always put them in their advantage position to always maximize profit. But according to Keynesian, they believe adjusting of price will bring about damage to the firm in the market. So neoclassical, neo-Keynesian economists do not agree with short-term profit maximization. But you have to understand that for the neoclassical economists, they want to produce at any point in time, in as much as the price they are going to sell is above the average cost of production in the short run. So in the long run, if they are unable to make profit in the long run, they will leave the market. That is the assumption of neoclassical economists when it comes to maximization of profit. They want to maximize profit, yes, in the short run. But in the long run, they have a plan in the long run. So the plan in the long run is if we are unable to make profit, if we are unable to cover our total cost in the long run, we leave the market. I think neoclassical economics is clear here. But for the Keynesian, they said, so here I said, okay, thus short-term profit maximization implies that firms will be prepared to supply even if they make a loss in the short run, so long as price is above the average variable cost. So it's all about selling above the average variable cost. That's all they want. Variable costs are the cost that these are the costs of that increases or reduces as output increases or reduces. So in as much as they are able to sell above that variable cost, they are good to go. That is according to classical, because they always want to make a short-term profit. So in the long run, firms must cover all their costs or they leave the market. Like I said earlier, if in the long run they are unable to cover the total cost, they would leave the market. That is classical economists. I think it's clear. But for neoclassical, for new Keynesian economists, they believe that firms maximize their long-run profit rather than their short-run profit. So for new Keynesian, they believe firms should always aim at maximizing profit in the long run. And to do that, that is why there's what we call the cost plus pricing. So whatever the price they want to sell. Oh, sorry. Hold on, sir.
Hello,
Hi, sir.
how's it going?
Good. So for the Keynesian, they believe firms have to start thinking about the long run. And in the long run, that means whatever price they are charging right now, it has to be with the markup. So it is cost plus markup to give them the price. So that means they would have made plans for the long run profit maximization. Do you understand the point there? Okay. So that takes us to, I'm still on profit maximization. Okay. So according to Keynesian, so I said, according to Keynesian economists, they argue that short-term profit might be detrimental to the profit and operations of the firm. A short-term profit means firms have to adjust prices and output in response to changes in the market condition. These rapid changes may damage the firm's position in the market. So why the Keynesians do not believe in classical theory is that they felt that every now and then we have to adjust prices. When you adjust price, you have to change the price tag. You have to inform your customers. You have to inform your workers. You have to advertise again. All these things makes people see you as being unserious.
Or maybe they see you as greedy.
As greedy, like you think more of profit rearing. You just want to make more profit as possible. So they will start thinking about alternative. So that is why the Keynesians do not go in line with classical economists when it comes to short-term profit maximization. I think the point is clear there. So the next one is revenue maximization. Are you there?
Yes.
So for revenue maximization, I wrote, revenue maximization is the theoretical objective of a firm, which attempts to sell at a price which achieves the greatest sales revenue. So for revenue maximization, you just want to, the aim is making the highest possible sale in the market. Then if that has to happen, then you have to sell where marginal revenue equals to 0, which means you have to sell to reach your total revenue, to reach the highest total revenue. You will not think about marginal revenue. All you have to think about is selling all the products at the highest possible. So even when whatever you have as extra, it has to be sold below the price to obtain the highest possible. If not, your marginal revenue will go into negative. You get to understand what I'm explaining anyway. So I said, therefore, it is assumed that the objective of managers is to maximize total revenue for the firm, subject to profit satisfying constraints. For revenue satisfaction or revenue maximization, this could be the aim of managers, because managers believe that if they are able to sell the highest possible compared in the market, it can justify their pay, and it will also give them prestige in the market. Oh, company A has the highest revenue in the whole industry. That means the managers in company A are doing well. That improves the prestige of managers. Do you get the point here?
Mhm.
So when you talk about, for profit satisfying constraint, it simply means the focus is achieving the minimum acceptable profit rather than making the highest profit. So it's profit satisfying. We're going to make profit that is acceptable enough for the shareholders. So whatever the rest is, we just want to sell as much as possible. Get the point here? There's a profit satisfying constraint, which simply means the focus is making sure that you make a profit at a level that is acceptable by the owners of the business. Then after that, you don't care about making more profit. So you think about selling more. That is what they mean here. So here I wrote, profit satisfying constraint profit satisfying constraint occurs when the firm focuses on achieving a minimum acceptable level of profit rather than maximizing it to the fullest. You're not thinking about profit maximization. Profit maximization occurs when your MR equals to your MC, but here your MR must be equals to your zero, must be equals to zero. So you just want to make profit that is enough for shareholders to agree that you have done well for that year. So this allows senior managers to get higher pay and increases their prestige in the market. I said that already. So that's about revenue maximization. For profit maximization, MR must be equals to, it is the point where MR equals to MC. For revenue maximization, it's the point where MR equals to zero. And now we go to sales volume maximization. For sales volume maximization, we're simply talking about selling the volume now, not the sales, the volume. And volume is about size of the organization. So let's read. For sales volume maximization, this implies to ensuring that the number of products sold are maximized. Sales volume can be used to measure the size of a firm. Sales volume is maximized where AC equals to AR. So for sales volume maximization, it is where your average cost equals to your average revenue, or where your total cost equals to your total revenue. When I'm doing the graph analysis, you understand. So we'll go to figure 1 analysis now. So the graphical analysis of figure 1. So I wrote, for profit maximization, we said profit maximization is where your MC equals to MR. So in this graph, your MC equals to MR at where your OA. So for MC to be MR, look at the points here. Our MC is equals to MR at where the output is at 0 OA. Do you see it there? OA is where MC equals to MR. Your marginal cost goes up, your marginal revenue goes down. I think you can see that, right?
Mhm.
So the point where MR equals to MC is OA, and the price is at OE. So a profit maximizing firm will produce at an output of OA and sell at a price of OE. That is profit maximization. And when you look at it, output level here in this market is ABC. The lowest output level is OA. The highest output level is C. So a profit maximizing firm would produce where? It will produce where OA. So a profit maximizing firm will produce where we have OA at the lowest possible output, and OE the highest possible price. So for profit maximization, it means you are selling at the highest possible price, and you are producing at the lowest possible output. Lowest possible output, highest possible price is where your MC equals to MR at this point.
Mhm.
MC equals to MR. This is MC, that's MR. I think you get the point here.
Yes.
So that is profit maximization. So profit maximization in the short run is where MC equals to MR, and the points for the price will be OE, and the output will be at OA. I think it's clear. It's clear, right?
Yes.
Great. So that's about profit maximization. Then I wrote for profit maximization, a profit maximizing firm will produce at OA and sell at OE. Where OE is the highest possible price in the market, this can be achievable by producing at the lowest possible output, which I just explained. Then we have the revenue maximizer. Are you there?
Yes.
So for revenue maximizer, it will be basically determined by the demand in the market. So for revenue, revenue can only increase if the demand for a product increases. Yes or no?
Yes.
So if the demand has to increase, you have to sell at the demand curve of OB, where your marginal revenue equals to 0. Your marginal revenue is 0 here. Your marginal revenue, this is your marginal revenue, it's 0 at this point. Do you get it? So the marginal revenue is at 0. So that is the point where you have to sell. So that means you produce at 0 OB and you sell at OF. Are you with me?
Yes.
You can't sell at OE because OE is for the profit maximizer. So you can only sell at OF. So selling at OF, producing at OB means your marginal revenue is equal to 0 in the same line with O. Are you with me?
Yes.
So a revenue maximizer will produce where MR equals to OB. Or I think the point is clear.
Yes.
So selling a little above will result in a negative MR, therefore will affect the total revenue. Selling above it will mean that your marginal revenue will be at negative. And remember, for a profit maximizer, they want to sell where MR equals to MC. So if a revenue maximizer wants to sell at the same price as a profit maximizer, the marginal revenue will go to negative, and that would affect its total revenue. And remember that it is only when demand increases, that you can sell more. So you will always want to sell below the MC. Is it clear?
Yes.
Below the MR, below the MR. I think my revenue maximizer is clear here.
Yes.
So the formula for revenue maximization is MR I think I wrote it out. Is MR equals to 0. That's for revenue maximizer. Then we have the sales volume maximization. For sales volume maximization based on the graph, it is where your AR equals to your AD.
AC or
AR equals to AC, where your AR is your demand. So a sales volume maximizer will be aiming at selling at the highest possible output, which is OC, and the lowest possible price, which is OG. Do you get it?
Yes.
OC, OG, which is GL. That is where that's where we have our AC equals to AD. So for a revenue maximizer, they want to sell a sales volume maximizer, they want to sell where AC equals to AD. For revenue maximizer, they want to sell where MR equals to 0. And for the for profit maximizer, they want to sell where MR equals to MC. I think it's clear.
Yes.
Any question about this?
No.
So that ends the 3 objectives of a business. The next class, we're going to talk about profit satisfaction.